Well, thanks so much for tuning into this earnings interaction with ICICI Securities. And as is norm, Vijay Chandok is with us to talk about how the quarter went by. I must tell you, it seemed to be a very strong quarter across revenue streams following what was a strong FY21. The question to Vijay is that the momentum that they are showing in the client acquisition, can that continue, and then can that result in a slightly better performance in some of the key segments that I want to talk to him about? But overall, Vijay, you must be pleased with the performances, because I saw across revenue streams, you more or less have performed exceptionally well. What stood out, and what is it that you wish to improve upon?
Thank you very much, Neil, for having me on this show. Good morning to all the viewers. Yes, the quarter is done with. Our focus is on the future. When you look back, we've seen a growth in revenue. The revenues come on a YOY basis. It's grown across segments. What is sort of being important for us to feel encouraged about is the growth in the new client acquisition. And also the efforts of digitization, which is actually beginning to play out now. Our efforts to simplify, smoothen all those digital efforts that we have invested on continues. So to your point, I think the current quarter has been led by growth across. What is really important for us is the digital efforts that we've invested in, and that is beginning to show early signs of traction. We've seen 2 sequential quarters of growth, and going forward, we only are expecting the growth momentum of new acquisitions to actually increase, because as we are smoothing and making processes and introducing plans which are more conducive to this style of customer acquisition, we hope that we will continue to keep that momentum of new acquisitions only increasing. In a way, we are also seeing that the momentum of newcomers to the market, which picked up at the time of the last lockdown, the first lockdown, first quarter of last year, that momentum, one thought, could probably abate, but through this quarter, it has only become stronger. What we did all of last year, if you recollect, was 3 times what we did the year before as an industry. And in the first quarter, we've already done half of what we did all of last year. So the momentum is actually not just let alone abate, it actually seems to be getting stronger.
So, I would also want to talk about how, in your own words, as you said in the last few interactions, that you are not just focusing on the broking business, but the others. And we'll come to the capital markets segment because that did well. But just a couple of questions on this broking segment. Will the pace at some point of time in the near future cool off, Vijay? Because typically that's what happens, right? There are bursts, and the bursts last for a bit longer. But at what point of time do you believe this can cool off? Because not only your peers are doing very well. I was speaking to Dinesh Thakkar, and he was saying that he expects the growth momentum to last for years, and which I presume may well be, because if CDSL has 4 crore accounts and it's showing the way things are moving. But the rate of change, when do you reckon this can show some signs of cooling off, or is it difficult to predict that?
So that's a great question, Neeraj, and we think about this all the time. And I think you can lean on to the past, you can lean on to putting some wisdom onto the past, that you come and you take a call. But you need to be aware that you can go wrong. So the way we are thinking about this is, yes, we are sort of taken a view, and we are increasingly convinced that this view is probably not going to be a short-term view, what we are seeing just now. It's probably going to be a more longer-term view. And I'll elaborate in a minute why we feel so. And at the same time, you have to be clear that markets being markets have its own way of showing its color. So it's important to sort of plan for, peak times in the market. So our whole approach is to expect a growth, but plan for a downturn. And that is why a lot of effort that we are putting inside the company, and driving our strategy towards, is to diversify. Because we want to reduce our dependence on capital markets, even as we invest in capital So which means that we are investing in other areas a lot more. And you can see the efforts sort of playing out. One trend that we believe is here to stay is increasing money flow into financial markets, generally speaking, whether it's in capital market related equities or it is quasi capital markets, which is mutual funds and fixed income and all of that. So we are spreading ourselves across the spectrum. We are diversifying so that in the financial services landscape, we offer everything that is probably possible on the table, including providing access to loans, access to protection services, and so on and so forth. All of which are growing, and some of which are not linked with capital markets at all. But coming to your point on capital markets, it just looks like beginning of a new trend, which is the coming of a digital native into economic India. Right? He's a guy born in the mid-90s who's born with a mobile phone virtually in his hand, lives inside the mobile phone practically, and you have to be therefore structured to live in his life if you want to be relevant to him, because that's the way he engages and transacts, and that's the way he sort of gets inspired and influenced by. So you have to be in that format in his life to get his attention. And this Indian is coming to an age where he starts early. This demographic, if you go back and dig into the demographic sort of side of this population, you will find that about 1.5 crore Indians have turned 25 in 2020. Another 1.5 crore Indians are turning 25 in 2021, and 2022 another 1.5 crore, and 23 another 1.5 crore. So you have, for several years, give or take, 1.5 crore Indians coming into working age, and this Indian is a digital, mobile-centric Indian, and he does not have any qualms of investing into financial assets. He's very comfortable investing into equities, mutual funds, fixed income, all digitally. So if you're in his life and his format, I think companies who are able to make themselves available in his sort of style will gain the momentum of growth, and probably that's why I would believe that this if you handle this well, you can actually gain a secular trend of future flows into the financial markets.
Oh, that's awesome. So you get the customer first. Eventually, at some point of time, you start mining him more or mining her more, and that just keeps on getting you a revenue stream, which is great. Okay, so that is part one of the conversation. Now, I'll just before I come to the non-broking piece, just one question on the employee expenses, which shot up quite considerably, Vijay. I want some clarity here. Did you front load a lot of variable expenses, and will they therefore show a complete evening out or bottoming out in quarter 2, quarter 3 onwards, or no, there are some other factors to this?
So you have to look at it in two ways. First and foremost, last year was an unusual year, right? There was so much uncertainty when we started off. No one knew how things are going to play out. So we actually, in a way, we saw a very good Q1, and in line with that very good Q1, because broking industry, you would recollect, Q1 was good despite the pandemic playing out. There was, in a way, a front loading of our employee costs, because it was aligned to the way in which we sort of reward our employees. And therefore, if you look at the whole year in perspective, that front loading had a sort of a lower cost attributable to the final quarter. So when you look at it in a sequential basis, you will see what we just said, that costs have gone up. But when you normalize it, you will see that the number is, which would typically happen in a normal non-pandemic sort of a year. You will see that it's a lot more sort of trending in a normal fashion rather than having these front-loading impacts. So this year we expect it to be more normalized. But that said, we are also investing, right? We are investing for future growth. I described to you that we are taking up all that digitization is important, the broad base suite of products is important. So we are hiring a lot of people in the domain of analytics. We are hiring a lot of people in the domain of technology, digital, cloud, those sort of capabilities, so that we are making the company future ready. So there will be some impact of cost on them. I don't expect it to be a very large impact. So and overall, I don't expect our guidance that we have given up in terms of cost income ratio being below a certain percent to sort of change at all. So we are very cognizant of operating leverage that we have to do, and we have to do our cost spend wisely. So that's how we are looking at.
What's that percentage, Vijay?
So last year to this year, last year was 53% in Q1. That overall cost to income has come down to 44%. But if you were to look at sequentially, it's a 40 to 44%, right?
Yeah.
And probably that's what gives a color. So there will be, we expect it to be well below our guidance of 50% through this year when you look at the year in perspective. The investments that we are doing today in manpower will have its impact in times to come. There is disproportionate benefits of an operating leverage model. So sometimes the cost comes in when the employees are hired, but the impact of the work that's done by the employees sort of plays out for long periods of time. And the work done on a digital platform can handle very large population without need for increased data or OpEx that much.
Sure. The other question would be what most analysts are banking on when they are raising your earnings estimates is, of course, the traction in the broking business and the investment banking pipeline, which of course no one needs to say is looking very, very healthy. The IPO mania is there to see, but it's not just IPOs. I think other than that also there are a lot of deals in the offing, so to say. How confident are you of that segment doing well? And would YOY FY22 over FY21, would that be that big differentiating factor? Because I don't think the pipeline was as strong in FY21 as it is looking right now in first quarter FY22 itself.
So, Neeraj, if you go back into, first I'll just express our company's sort of structure in terms of its dependence on its IPO business. 85% for us is retail, 15% is non-retail. Within non-retail, you have institutional broking and so on and so forth. So IPO is really a tiny part of the total dependencies in terms of profits as well as revenue. Right? So that's first things first. Our entire value drivers are going to be, we are very clear in our mind. Value drivers in this company is going to come from wealth retail distribution. Right? So that's the area of attention, focus, and value creation in our mind. This is a very important business because it feeds into the wealth business quite smartly, right? Within that also, within the institutional part, our effort is to look at businesses in two ways. Stuff which is episodic, stuff which is predictable and flow style. So there are businesses within this which are flow style, and then there are stuff within which are episodic. The stuff which is episodic is IPO, the one that you described, right? We have historically been quite strong in that business. So right now the markets are doing well. So we are getting the benefit of that strength in the market. We understand that there are going to be times when that market is not going to be, it's going to be tepid, and that is why that segment of the business itself we are sort of texturizing in a way to become stronger in the flow side of business. For example, the QIPs, it's a lot more predictable. For example, the institutional side of the business, that's a lot more predictable. So our flow market shares, etc., are going up. We are investing quite a bit there. That's not such a glamour business which you will sort of hear and see about. Probably they don't typically make headlines, but they're great businesses because they bring predictability and they bring stability to the flows. So last year, you referred to last year pipeline not being good. Actually, just to give you some data, last year was perhaps the best year for Indian capital markets in terms of IPOs, but this year it's looking even better. So pipeline, as you correctly pointed out, is pretty healthy, and we are sitting on a lot of deals. Markets remaining where they are, that pipeline should play out during the course of this year.
Yeah, no, Vijay, what I meant was relative to FY22, FY21 may not be as healthy because FY22 just the start looks so good and the pipeline is just looking so robust. Okay, now I'll not get into the conversation, paucity of time. I won't get into a conversation about whether the market share did get impacted because of the margin unit, because it seems that it hasn't. What I want to, as a final question, ask you, Vijay, is that when I look at and ISEC currently is probably a very different animal because of the digital native customer coming to you compared to the previous years. But all through the previous years, while you've grown the way you have, you've grown at a very admirable return ratio maintenance, if you will. The profitability metrics have not gone awry behind chasing growth. Now that you are looking at very high growth possibilities for this system because of the factors that you outlined, do you reckon that you will be able to maintain or improve upon the return ratios, profitability metrics, while sustaining much higher growth than what you may have seen in the preceding 10?
Yeah. So growth has got two elements, growth of input parameters and growth of profits, right? There can be a mismatch in terms of timing. Right now, efforts are on growth and input parameters. We are putting a lot of effort behind it, and we believe that growth and profits and revenue, etc., will lag. Once they're all in place. So while you're doing growth and input parameters, there could be some sort of a softening of the return ratios, which is what you would have seen. 81 has gone to 63. Yeah, so that's the scale of softening, because the nature of the business is such. The nature of the business is a low capital consumption business. It's a low receivable risk business. It's a low inventory, working capital intensive business. So you don't need all of that. The only place where we sort of need capital is for technology spends. And in Indian context, technology spends, unlike probably in global context, is not a very expensive, relatively expensive thing. So we have enough resources within the company to handle all those investments through our capital. And given the nature of this business, if I get to lean on history just to give you a sense, 10 years we've seen ups, downs, investments, continuous modernization within the company. We've never seen it generally come below 40-45% return ratios. Compared to today, it may sound a little low, but that's what we've seen last decade. But there would be very few companies in India who would consistently be able to deliver a 40+% return. So we are talking of a scale of that nature, and that itself we believe is a very decent return ratio.
Well, all the best for that, and better growth than what you anticipate as well, Vijay. Though you've done very well in Q1 on the back of a very strong FY21. So wish you all the best for that. Thanks so much for speaking to us today.
Thank you so much. Thank you to all your viewers.
Thank you, and viewers, thanks for tuning into this conversation.